Welcome to the Lend Academy podcast, episode number 226. This is your host, Peter Renton, founder of Lend Academy and co-founder of the Lend It Fintech Conference. Today's episode is sponsored by Lend It Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on May 13th and 14th, 2020 at the Javits Center in New York. Lending and banking are converging, and Lend It Fintech immerses you in the most important trends of the day. Meet the people who matter, learn from the experts, and get business done. Lend It Fintech, lending and banking connected. Go to lendit.com/USA to register. Today on the show, we have a special guest, someone who I would even say has become a bit of a legend in the fintech space. I'm delighted to welcome Steve McLaughlin. He is the founder and CEO of FT Partners. Now, FT Partners is a boutique investment bank focused exclusively on the fintech space, and it's been around since 2002. So Steve was really thinking about fintech before any of us, pretty much. And I wanted to get Steve on the show. Obviously, they're in many of the big deals that happen in fintech, facilitated via FT Partners. So he's got an incredible perspective on the industry. We want to talk about that, talk about the trends that he's seeing. We talk about the research reports that come out on a regular basis from FT Partners and what goes into them. We talk about valuation and the different ways that the private markets and public markets look at that. We talk about SoftBank, we talk about M&A, and much more. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, Steve.
Well, thanks for having me on, Peter.
My pleasure.
Looking forward to it.
Okay, so what way I'd like to get these things started is just giving the listeners some background. I know you've been doing FT Partners for many, many years, but let's just take us back to what you did before you started that and what you've done in your career to date.
Sure. I started at Goldman Sachs initially as a summer associate in 1994, then started full-time in 95 in New York City in Goldman's Financial Institutions Group. This is, I guess, back when it was pre-public, still a private company run by 118 partners at the time. But I got put into the Financial Services Group, and that was, 95 during the pretty big boom in M&A and capital raising for banks, insurance companies, brokers, asset managers, and it was pretty much the busiest shop on the planet for all that kind of stuff. But as you can imagine, given it was 1995, we also saw the beginnings of, everything around the internet, creeping into financial services. So there was, anything you could think of, .com and financial services, mortgage.com, lending.com, insurance.com, and bank.com, and BankNet, you name it. There was hundreds of companies. And so, that's what I started to focus on. It was an area of the world that, mostly was undiscovered because most of the companies had very little revenues back in the day. But that was back when we started seeing the first signs of the Charles Schwab going online and Scottrade and E-Trade and Ameritrade and so on and so forth, and all the stock exchanges getting electronified and digitized. And so I was in the middle of all that. And was really one of the only people at Goldman, let alone on the street, focused on that area of fintech. And that became 100% of what I was doing. And I was either running or co-running the fintech group, towards the end of my tenure there before leaving in 2002 to start FT Partners.
Okay, so then what was it that, you were really ahead of your time in many ways because fintech wasn't even a term back then. Obviously, there was financial technology, but why decide back then? What was the thinking behind, starting your own firm, back in 2002, and this is sort of obviously coming out of a recession. Why do it then?
Sure. Well, I saw just a huge, huge opportunity in fintech. Again, like you said, it wasn't called fintech back then. We called it financial technology, which is the name of the company, Financial Technology Partners. So from '02, that's been the moniker. And so, but I just saw a tremendous amount of inefficiency, in the system. Really, even today, I think that the opportunity is way larger than what we're seeing, in the market, and people think it's large today. So, back then, it was pretty clear to me, but it was also clear to me there weren't any investment bankers that were that focused on it. And there certainly wasn't an independent boutique focused on the space. And so, I thought that was a great combination of picking a great space that nobody was covering, and a space that's actually quite hard to cover because it covers a lot of different disciplines from, like I said, all the different pillars of financial services, but all the different technology types. So it's quite complicated. And then you also got the big banks, people coming at it from a lot of different directions. If it's an insurtech company, you might have an insurance banker coming at it. You might have an IT services banker. You might have an internet banker. And then on the research side, there's sort of a fight for, the clients wanting to be covered from more of the tech side, but some of the companies getting pushed over into the financial services research coverage. So there's a lot of internal difficulty in terms of people organizing. You still see it today. You see a lot of the big banks don't really have a cohesive fintech group around the world, and there actually isn't a single investment bank that even has a single fintech group around the world. They're fairly fragmented, where people in Brazil, aren't talking to people in New York and not talking to people in London, and certainly people in the tech group aren't talking to people in the FIG groups of these firms, and so it just creates a lot of disjointedness in the client coverage and the knowledge base. So, I just saw it as a huge opportunity, and really fast forward 18 years, it's still as messy as it was back then. So we're about 160 people today, focused 100% on fintech, and that compares to just a few people focused on the space at any other given bank, including the big guys. So, it's an all-out effort here.
Right. And so, and where, I know you have a global focus these days. So where are your offices located?
Yeah, so we've always been sort of headquartered in San Francisco, but then about 5 or 7 years ago, we opened up a New York office, and then we had a London opening a couple of years ago. So we're sort of spread between San Francisco, New York, and London. San Francisco is probably 80 people today, New York probably 50, and London 30, up from 0 a couple of years ago. So, and then we're covering, like you said, the world. We have billion-dollar deals and startups on really all continents other than Antarctica. So we just announced yeah, seriously, we haven't gone into Antarctica fintech yet, but we just announced a fairly large investment from Visa into a company called InterSwitch, which is one of the most valuable companies in Africa now. We're working on a digital bank project in Southeast Asia. We're selling a significant payments company in Australia in a couple $1 billion range. And so really, and then worked on the Stone IPO last year in Brazil. So, really you pick your continent, we're there and we're doing things. So it's exciting times. Fintech knows no bounds, I guess. Right.
And one thing that I've always appreciated, I know many others as well, are your research reports. You do these quarterly fintech research reports, and you do other industry reports. And I just saw in my inbox this morning a African fintech report, and these are not just 5 to 10 page reports. These are 100+ pages long. So maybe you could sort of talk a little bit about what goes into these and why and this is all for free, obviously, why go out and provide all this great intel?
Sure. Well, I think, like I said, it goes back to we have 160 people focused on the space, and there's a significant number of those people that are in our research and business development group, which is the core of the company where all the knowledge, kind of pervades from, if you will. So a lot of it is, we're doing an enormous amount of, independent proprietary research for ourselves. What's going on in Africa fintech. There's hundreds and hundreds and hundreds of companies, which are the good ones, which are the ones that are growing fast, which ones are stalled out, who's getting funding, what segments, how does that compare to what's going on in other emerging markets. So we're doing a lot of it for ourselves, and then we're taking a sliver of that and sort of, kind of publishing it out into the marketplace. So there's a lot more behind the scenes of what we're publishing. And so it's a little bit of a teaser to, what do we know? It's also a little bit of a public service because it's become quite popular, and we've got millions of readers of our research. And, when we publish something, we can see it light up on the screen as it gets opened up and looked at and forwarded around all over the world. So, part of it is we just become part of the ecosystem of, what's going on and sort of the, central source of knowledge and defining how the space is structured and who's doing what around the world. And so, but there's really nobody else out there that's doing this the way we're doing it. There are people that are trying to collect the data or trying to, create, a 3-page newsletter once a month. But in terms of, the volume and the number of people that we have dedicated to this. It's really unheard of, but it's actually a lot of fun because we get invited to speak to a lot of incredible boards of directors and conferences and special think tank type groups. So we got a great team that's focused 24/7 on that. So it's pretty exciting.
Mm-hmm. Okay, so let's talk about some of the actual trends that we're seeing today. And I was looking through your last research report, and there's you isolate several things, but one thing that I maybe get your take on right off the bat, and that is a lot of people talking about this lately, with the big tech entering fintech, and obviously we got Google, Apple, Facebook. They've all been in the news just in the last month or two doing new fintech initiatives. What do you expect to see from big tech going forward?
Sure, I think you're going to see more and more convergence between sort of payments and financial technology and big tech. I mean, you saw PayPal make the acquisition of Honey the other day in the e-commerce space. You saw Google make the announcement about getting into checking and digital banking. We've all seen Apple get into the space with Apple Pay and, of course, the Apple credit card. So I think you're going to see more and more of that. You've also seen Amazon get involved with lending to its SMBs, and they're a little bit behind in the payment space, but catching up. And then, of course, people like Grab in Southeast Asia and Uber here in the U.S., getting more and more into financial services. So, and I think what you're seeing is more of a trend towards financial services and fintech, if you will, kind of pervading every single type of business. So, the money flow is really what keeps businesses going, and whether you're spending money, making a payment, saving money, optimizing an expense, you name it. It's just a big part of each and every business and all the flows between customers. And so you're seeing more and more people get involved in it. I mean, I think there's an opportunity more for the big, if you will, e-commerce players, to get in and disrupt the banks. And I do think that's possible. Would you rather have, a checking account with Amazon or Wells Fargo? I think that's debatable. Wells Fargo is certainly a very highly regulated bank, but has had its customer service issues, whereas, Amazon is, off the charts in terms of customer satisfaction. So I think, what a lot of it's coming down to is data. So, he who, has the most data on the consumer, can probably be helping the consumer manage their finances better than others. So I think it's long term going to be a data play.
Right. Got it. Okay. So then I think that points to another, and there's obviously many companies that you've worked with directly that have a big role to play here. There's companies like Marqeta that have really created a whole new kind of way of managing the payments infrastructure, and you've got other companies like Bluevine on the small business side, and I'm curious about the fact that there's becoming this plug and play type aspect of fintech. It feels like, and I know that Matt Harris from Bain had a pieces out recently talking about this. And do you think that we're going to see beyond just the big tech, but lots of the big brands come and have their own sort of fintech offering in the future?
I think, like I said earlier, I know the report you're referring to that Matt Harris put out there. Huge Matt Harris fan, by the way. But in any event, yes, I think fintech is becoming a bit of a platform, right? There's a view that there was, the internet, there was mobile, there's the cloud, and now there's sort of fintech, right? And so fintech being sort of the fourth, if you will, horizon of platforms in tech. And I do think there's a possibility that it gets looked at and the world thinks about it that way. And we're seeing it embedded in all walks of life. You look at what people like Expensify are doing, with millions and millions of users, doing their expense accounts. And now I just read they're launching a card platform, and I'm sure they'll eventually do payroll and billing and everything else. So, I think there's this concept of getting in and, landing, with particular, enterprise or SMB, and then being able to offer them a more myriad of services around financial services or financial transaction processing. The other thing you're seeing a bit more of, and Expensify is probably not a bad example of this, is companies that are able to sort of extremely uniquely penetrate both a business ecosystem and a consumer ecosystem. And that's where we're seeing some really, really breakout plays. Like you pick a Square, for example, they're going after, not only, 25, 30 million SMBs, but also, going after and already have, call it 20 million consumers using their apps. And so at the end of the day, if they can bring those two constituencies together, you kind of create a super business model around financial services. And you see the same thing with Facebook, where they're going to their consumers, going to their businesses, and basically creating this cohesive ecosystem. And I think financial services is helping bring the glue together on that as well. So
right. So okay, then what? You haven't really talked much about digital banks yet, and that feels to me like it's the hot sector globally. It feels like right now, where there's a lot of mega rounds happening. There's a lot of customer acquisition happening, rapid growth. And I look at it, I think back to the lending days. And in fact, the time when we first met in person was at Lend It 2015 in New York. And that was sort of a conference where there was peak enthusiasm for the lending space. And it feels like now it's peak enthusiasm for the digital banking space. But maybe what's your perspective? I mean, a lot of these companies aren't making money yet. Do you think that what do you see playing out in the digital banking space?
Sure. Well, I think look, we like the online lending space too, but I always thought that the online lending space had issues just given the very nature of it being you're lending money out, you're hoping to get that money back. It tends to be a one-off transaction where, 2 years later when the loan's paid off, the person's going to shop around and get the cheapest loan from somebody else. And people have not really, I think, done a great job in the online lending space, kind of transversing sort of providing a loan to someone to getting a broader customer relationship. I think there were some attempts to do that, but it largely failed. And so, on came the digital banks with the idea of, if we can control your checking account, we can have an interaction with you every single day of the week with your spending card, whether that's a debit or a credit card, and then we can sort of collect all sorts of data and information. It gets back to what I was saying before about an information game and data game. And then once we start doing that, if we're in your checking account, we can see, where your paycheck is coming in and what your monthly and daily expenses are, what your rent looks like. If you lose your job or you get a promotion, we can see that too if we're the digital bank. And so I think the idea is that, anchoring the client with a digital banking product and a checking product and a direct deposit product, is a great anchor. And all of us sort of, I think, would agree it's fairly rare for you to change your core checking account. So, but that being said, that's the hardest part to get. I think the idea, though, is that once you have that core checking account, you're pulling all that data, it's not so hard at that point to start offering savings products or other lending products or expense management products or financial advice products. So I think that's where I think there's a bit of a battleground and a bit of a branding battleground as well. And with the banks having, I think, slipped up in terms of customer service, in terms of product offerings, in terms of their digital offerings, it leaves a huge gap for some of these digital banks to come in and make hay. I think one of the things we're seeing is very few of these have, sort of gone, cross border. I think a Revolut is a rare example of someone who's raised a significant amount of money and is sort of, I would say, going for it. And I love those guys. You talk to them, they're talking about building $1 trillion, digital banking platform, which is really exciting. I wish them all the luck in doing that. But, you see a lot of other players that are more country specific and are focused on building, call it, $20 billion, $50 billion, $100 billion businesses, in single geographies. And you look in the U.S. at companies like Chime and Vara Money, and one of my favorites being, Moneyline, so sort of helping the everyman, or if you will, the working American. I think there's a big dearth of, financial products out there for the working American or the working European or what have you. And some of these are really, really helping consumers, think about saving and spending and retirement and things like that. So I think digital banking is sort of the moniker people use, but it's more digital financial services hub, if you will. So is maybe a better way to think about it.
Right, right. Yeah, for sure. And, along with that, I mean, obviously the valuations that some of these companies are attracting, really pretty high valuations. I know you've got the new bank in Brazil and, that are, I think, 10 billion. And you've got many others where you've got, in at the same time, you've got in the public markets, a lot of these IPOs have struggled. Maybe obviously Square's an exception and there are a couple other exceptions, but how do you look at what, when you're sort of talking with these private companies and they're getting these massive valuations, and you also taken several companies through IPO, do you see the fact, what do you tell people who are looking to go public as far as valuation goes? Do you think that this valuation feels like it's like this bifurcation where you've got two completely separate realities? And I mean, how do you see that sort of correcting itself, or how do you see it playing out?
Well, I think you have to think about what's going on in the public versus private markets. In the private markets, first and foremost, most of the securities that are being sold are convertible preferred, so the downside's protected. There's sort of unlimited upside potential, and the trade-off there is just not enough liquidity. There's no liquidity in that. Theoretically, no liquidity or less liquidity in public markets. In the public markets, it's all common stock with no downside protection. And you think about the other distinction, the private market, you see all these rounds. It's typically what the top one or two people in the world are willing to pay after having done a significant amount of due diligence and, under competitive pressure. Whereas in the public markets, you're really only left with a 10K and some 10Qs and some research reports, limited amount of diligence you can do. And, it's sort of the equilibrium of everyone who thinks it's to buy and everyone who thinks it's to sell, right? And so as opposed to whoever thinks it's the best company in the world and put the highest price on it, that's typically not the valuation for the public market. So I think one of the realities of all these private companies when they go into the public markets is like, it's not about what you can convince one person to pay. It's what you have to convince the entire universe to pay. And that universe consists of a lot of skeptical research analysts whose careers are on the line, and we're going to be, potentially more skeptical than someone who is, highly optimistic and has a highly diversified portfolio and has downside protection. So I just think there's a huge difference between public and private markets. And I think, the public markets are sort of the ultimate reconciler of valuation to some extent. And we've also found public markets to be quite wrong about a lot of companies. You look at some of these companies that are a bit, out of favor, like a lending club or what have you. I mean, look, Microsoft, Amazon, Facebook all had moments where their stocks were down and dropped and no one cared about them, but they continued innovating. And then, later on in life became, massive companies. So I think you can't really count, any of these companies out, but it's what makes the world go around, supply and demand. And I think the thing is, you're not seeing a lot of retail investors, pile into these private deals. These are smart, right, incredibly well diligencing companies that are making these big bets, and they're comfortable doing so. And there will be winners, there'll be losers, and I don't think anyone should be surprised that occasionally someone will invest in a company at a $3 billion valuation. It might go public at $2 billion. That's just life, and that's just what's going to happen once in a while. That's why it's venture capital, so to speak. So. But some of those are going to go from $2 billion to 20 billion. You look at Square, came out of the gate. Everyone thought it was overvalued, and stock, suffered in the IPO moment in time. And you could have bought it any one of us could have bought it for $9 a share and sold it for 100. And that was there for the taking for everyone in the space. With the spotlight on it. So public market can be a really good thing.
Right, right. So when you're working with these CEOs, do you encourage them to try and maximize the valuation, or is it just a case by case basis? Because obviously it has some downside if they are planning to go out in the public markets.
I would say when we talk to clients, we let them sort of think about what's important to them, and we're usually encouraging them to think about quality of investor, leaving money on the table in order to make sure you're not overpricing your round. But at the end of the day, the market's the market, and we are getting some great valuations. But you really don't want to get your valuation too far ahead of yourself, because it could become difficult to raise future capital.
Right.
But yeah, it's all about what the client's looking to optimize. And in a lot of these situations, they're looking to optimize valuation. But but also out of the same breath, they say, I want an investor that's going to support me through the IPO. I want an investor that's going to be good in the boardroom. I want an investor that's going to be supportive of, things when things aren't perfect, because they never are. And that's generally where they lean, is let's go find the right fit with investors. And, valuation winds up taking a bit of a secondary back seat.
Right. So I'd like to get your perspective on SoftBank, because they, I just saw that just out this morning, there's a new deal that they've invested in India and Paytm. And I'm curious about what impact do you think? I know you're talking with SoftBank at our LATAM conference, which will be in the past by the time this is actually published. But I'm curious about what your take is on their impact on fintech.
Sure. Look, I think SoftBank is, still a force to be reckoned with, despite some of the, tricky stuff they had to deal with in terms of, the WeWork situation and Uber and others. But look, at the end of the day, they're a very, very large, venture capital player. They're taking very, very big risks. They're swinging for the fences, and it is a portfolio. So we can all sit there and look at, the mistakes that they've made. And they have made mistakes, and they'll certainly admit those mistakes, and they're publicizing those mistakes. But I think, look, at the end of the day, they have a chance to move some really big needles and take some big swings, and they're trying to do it all around the world. So, I sort of commend them for their efforts in doing it. But I think they've also missed a lot of great opportunities. I think they tend to, chase momentum, and there's a lot of really good hidden things out there that they could be looking at. But, it is the Vision Fund. And so when you do talk to them, and we have a ton of respect for all the guys and gals that we talk to there. I mean, it's like, look, if it isn't something really, really game changing, then they don't want to spend much time on it. And like I said, I commend them for that. But in terms of fintech, I mean, they just invested in Paytm, they're in SoFi, they're in Cabbage, one of our clients, and they've done a lot of great deals in the space as well. So, but I don't think they're having an overall impact on fintech, to be honest with you. I think they're in a couple deals here and there. But, have they changed the game? Have they king-made anybody, which is a word we hear from time to time? And we really haven't seen that. I mean, Paytm is doing quite well with a huge universe of investors, including Ant and others. So I don't think there's any magic SoftBank put in there. And then there's plenty of competitors coming up on their heels in India as well. So. But no, like SoftBank's got a great place in this world, and like anybody else, they're going to take their lumps. And the venture capital game is swinging for the fences. They probably need to slow down and, lick their wounds and figure out where to go from here.
Right. Anyway, we're running out of time, but a couple more things I really want to get to. I want to talk about M&A, because it seems surprising to me. I'd like to see if you're surprised, the fact that traditional banks have not been very active in fintech M&A. Where do you think future M&A activity is going to come from?
Sure. I think the banks have been slow on M&A, but I think you're starting to see some signs of life there. I think the thing that's been most eye-opening to us is the deal that we actually worked on called Assurance IQ, where we sold it to Prudential for $3.5 billion. Prudential being a 144-year-old company, buying a company that had only been around for three and a half years for $3.5 billion. It's actually pretty impressive that they had the foresight to do that. And I think when Prudential looks at its business and sees the changes out there in AI and automation and online applications and what that means globally for insurance, I think they have the guts to go out and swing and actually take a chance on buying a very, very well-heeled, I think, smart acquisition with Assurance. And it's something that was probably the boldest move I've seen any financial services company make in the last 20 years. I mean, really, if you do the research, which we have, you just haven't seen anything like that in 20 years. You look at another deal we did, which is the Allstate buying a company called SquareTrade. They saw, the world of autonomous cars, and when millennials were not buying automobiles as much and living at home longer and not buying home insurance, they said we need to get closer to the millennial universe and buy a electronics warranty company, which is what SquareTrade was. And so that was $1.5 billion bet that Tom Wilson made over at Allstate, which has worked out incredibly well for those guys. These guys' stocks are up. And that was the thing, going back to the Prudential deal. I mean, I think the common wisdom would be if Prudential buys a company for $3.5 billion, it's a tech company, that the stock's going to go down. But I think the market realized it was a smart move. The stock went up 5 or 10%, even greater than the value of the company over the next couple of weeks. And it's been seen as a huge success. So I think that transaction has hit a lot of CEOs' radar screens and said, hey, it's not just for the PayPals and the Amazons that can go out and do $3-4 billion deals and have their stocks go up. We can do it too if we're smart about it. And I think the thing that I'll throw in there, and some advice to CEOs doing these deals, I mean, part of that was $1 billion plus earnout for the management team. There's a recognition there that you can't just sort of buy these companies and expect everyone to stick around. You got to think really hard about the team and what's going to incentivize them going forward. So let's give them an earnout and let's keep them, motivated for 3 to 5 years. So there's a transition. You look at another deal we just did in Europe where Santander bought 51% of an amazing company called eBury, another client of ours. And again, these are probably, you look at eBury and Santander, you look at Square Trade and getting bought by Allstate, you look at Assurance getting bought by Prudential, and we start actually stacking it up. These are like 3 of almost the only transactions where major, balance sheet businesses that have been around for, almost 100 years plus or minus are making these kind of bets. But you're seeing this stuff, and you really haven't seen this up until recently. So you could see a lot more of it.
Interesting. Okay, so then when you look at across the sort of spectrum of fintech, and this is the last question then, what area do you think is most exciting? What do you think, where do you see the most growth coming from?
I'm probably most excited about, I'm excited about all the different spaces, honestly, but I love what we were talking about earlier, the Marketas of the world, the Plaids of the world, the Expensifys of the world, the ones that are really powering, enterprises to do more around fintech. I also really like the B2B payment space, companies like Avid Exchange, for example, who, you can't think of too many people that are, in the business of getting rid of paper checks, right? In the B2B enterprise world. And Avid Exchange is leading the space there. So it's just companies like that are more in the B2B side of things where you're seeing a lot of action right now. And look, I love the digital banking space. I love what the Revolut guys at Number 26 and Chimes and Moneyline and Varo Monies. I love what they're doing. And I think what's exciting to me is I really do think at the end of the day, fintech is here to help consumers, and help companies be more efficient, which ultimately helps the end consumer as well. And so to me, that's what keeps us motivated to keep going and keep building our business. We think fintech space is really, really helping people at the end of the day, and that's what it's all about.
Okay, indeed it is. On that note, we'll have to leave it there. I really appreciate you coming on the show today, Steve.
My pleasure, Peter. Thank you, and congrats on everything you're doing at London.
Okay, thanks.
Talk soon.
See ya.
Bye.
Well, that was really interesting, particularly Steve was saying around M&A from traditional financial institutions. We keep wondering when the floodgates will open. Well, maybe 2020, 2021, we're going to see many, many more deals here. And I think he's obviously provided 3 examples there. And, I've heard of others that are sort of in the wings that are at the exploratory phase. So it's going to be super interesting. And I feel like the traditional financial institutions are not playing as big a role in M&A as I think anyone expected. And that could be very much about to change. Anyway, on that note, I'll sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode was sponsored by Lendit Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on May 13th and 14th, 2020 at the Javits Center in New York. Lending and banking are converging, and Lendit Fintech immerses you in the most important trends of the day. Meet the people who matter, learn from the experts, and get business done. Lendit Fintech, lending and banking connected. Go to lendit.com/USA to register.